Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Right. Today we've got Phuong on, which I think it's a pretty cool conversation. She's kind of getting into the nitty-gritty operational reality of quantifying how much money a founder should raise in each round. There are tools and techniques that VCs and serial founders know to calculate this. This is not an arbitrary number. And to someone who's newer to this process, it might seem a bit mysterious. She breaks it down into its pieces, unearths it, dives into some pitfalls, how to think about it. I think this is super useful. So if you're going to be raising financing rounds, venture capital, angel money in the future, this pod will help you know how much to raise and also what tools you need, in particular an operating model, and how do you create it so that you can calculate that number correctly. Enjoy. All right, Phuong, we're back in business after the summer.
Hey, Mark, it's good. It's good to be back.
I like doing these talks, particularly on the maybe more mundane aspects of kind of business prep. I'm just into it. One thought on this is a dozen years ago, I wrote a really boring book called The Fundraising Rules. And the concept of it was to help clarify to entrepreneurs the language, jargon, and structuring that VCs want to communicate in. And I think the world was a little bit backward at the time. It's a long time ago now, where VCs kind of wanted to keep their playbook and expectations secret. That's what it felt like to me. And the idea was that the pitch meetings were then a test. Do you happen to speak the way we speak or package the way we want it packaged? And the hope of the book was to put a common lexicon in place so that it was less of a test on how you say it, but more the substance. And getting people to be using the same language, delivering against expectations, but then focusing on the underlying substance of the company. Is it a good company? Even if you didn't know how to package it before. And so today's topic on financial modeling sits squarely in that, because I think that the financial model of a company is really the business plan. It's how it's how all of the nuts and bolts of the plan are actually communicated. And taking the same approach to creating that document is magical because it puts everyone communicating in the same language. And then everyone can focus kind of in the substance of, is it a good idea or not? Is the strategy a good idea or not? Is the operation a good idea or not? So anyway, I think this is super meaty and one of those topics that everyone kind of needs to nail. And it shouldn't be a mystery, in my opinion. It should be easily accessible so everyone can communicate clearly and then disagree or not.
Yeah, I mean, I think that putting the topic of how you represent your company financially to your investors under the context of answering this question today that we're going to approach, which is how much money do you raise? Right? That that financial model is really important in asking that question, and we get that question all the time. How do I figure out how much to raise? What's too much? What's too little? And so I'm really excited about that. I think that, you and I probably take a lot of these concepts for granted, when we talk amongst ourselves and with our founders, but I'm really excited to kind of put that out there today and kind of lay down the basics for everyone.
Yeah. And this is a cool one because there is an answer.
Yeah.
Right.
Yes.
Not one answer, but it's kind of an answer.
Yeah,
and there's
totally.
a method to get to that answer. And if you know the trick and the trade, you're going to say the right thing.
Yeah, that's right. And that's, that unlike some of the other things that we do when starting a company, it's much more of a science rather than an art, and there's, if you kind of like follow this methodology, I think you kind of end up in the new place. And there's like not an infinite number of answers. I think one of the first things you really need to think about when you're fundraising, I think one of the key ideas when you start is to think about how much money to think about the fact that you want to raise enough money to get to your next fundable milestone, right? So like when you start your fundraise, you need to think that between now and your next fundraise, you need to achieve significant traction that's going to make future investors excited to come in, right? So, and what is that? It's different depending on your stage and the type of industry that you're in, but it could be like hitting a revenue target, achieving product market fit, completing a beta test, or depending on your industry, something like getting regulatory approval. So like that's kind of like the key overall, like, where you should start your thinking when you're thinking about how much you want to fundraise.
It's completely dead on. I think what's interesting too is particularly on the software side, where the milestones, you could probably be a little bit more flexible at defining what those hurdles are. The fundraising conveyor belt, the machine that the VCs kind of sit in and their expectations are all dialed in around milestones that are typically achievable within a kind of a recurring time frame. And the VCs have kind of spaced out what those milestones are to match with those time frames so that there's a cadence to it.
Right.
There's a cadence to it. There's a rhythm. And so as you get closer into this, you kind of see that the whole industry has coalesced around kind of like this conveyor belt. It's like a factory assembly line of building companies.
Right.
Different stages
and then
at different
just to get more specific on that, like, for example, if you're pre-revenue, then maybe your milestone is to complete product development and to launch your beta. If you're post-revenue, already have some traction, then maybe it's, aiming for certain levels of revenue growth or getting to profitability. I think that's what you're talking about in terms of like kind of staging it based on like where you are and kind of this factory. I think like regardless of where you are, it's important to choose a milestone that clearly demonstrates you're de-risking the business, right? Like investors want to know or see that their money is helping you take big steps forward. And so you want to prioritize milestones that's going to make your next fundraise easier. If you could show that you've hit a key metric like significant user growth, then your next round is going to just be a lot more straightforward.
I want to say I think generally the milestones are changing a little bit because the cost and time to build a software product is declining. And so there is compression between what used to be first, second, third base. Now, first and second base might be first base. So there's some evolution that's happening. Right. But the short of it is, if you don't have a product, you got to launch a product. Once you have a product, you got to show that the unit economics work. That, if you put a little gasoline in the engine, that the engine's going to turn efficiently. Then you want to show that you can scale it efficiently. Put a bunch of gas in the tank. What happens? You're getting a capital efficiency. Every dollar you spend, you're getting an expected amount of revenue or growth and other KPIs, et cetera. And then after that, it's different growth plans to support that, whether it's expansion to cities, launching new business lines, et cetera.
Yep.
And that's those are generally the steps.
Yeah, I think that's right. And I think, when you're talking about like one particular fundraise, and kind of how long you have to reach some of those milestones, like I think one thing to consider is that, you want to raise enough to cover the runway that you need, right? So usually it's 18 to 24 months. That gives you 12 to 18 months to hit your milestone. And then an additional 6 months as a buffer to raise your next round. Like you don't want to be running on fumes when you're pitching to investors, and it always takes longer than you think to raise. So then I think that's also a good way to like backtrack into those milestones, like what's achievable in that time frame.
Totally.
Like you're not going to expand from no product to 20 markets in 18 months. So I think that's
one of the gotchas on these milestones too is when you figure out what the right milestone is. So let's say you're pre-product and then it's launched the product, and then you launch the product and then you're focused on unit economics. You may have to make choices on how you allocate resources that will determine whether you're really staying true to the milestone. For example, this is the one that usually people get wrong when they get one wrong. They might start trying to maximize revenue while working on the unit economics. That's the wrong decision. it's not important that you can show you can get a couple $1 million in revenue if you haven't yet shown that every time you spend $1 to acquire a customer, you make 3.
Right.
And a lot of the times when people are trying to maximize revenue, they end up doing strategies to maximize quick wins. Maybe they'll do door-to-door selling as the founder. Things that don't show how the economic engine will scale, because that sales strategy maybe doesn't go past a certain threshold. But buying the customers in the marketing equation or a sales function, something more scalable, will be repetitive, repeatable. And that's what people are going to bet on at that milestone in the unit economics is like, hey, you've got a thing that we can scale with. So doing all the other activities that might increase your top line temporarily, but don't give you a long-term scalable strategy aren't as useful. So there is something to kind of focus drift at that particular stage.
Right. And then, and I guess while you're doing that, you could theoretically raise enough money to help you accomplish all of those milestones, right? Just raise a boatload of money so that you have your bases covered. But there's a balance here. You don't want to raise too much in each round because that leads to over-dilution, right? Which is a real concern. How do you think founders should think about dilution with each round? Why shouldn't they just raise as much money as they can?
So the problem people typically fall into when they raise, let's say they need $10 million to get the business to profitability or whatever it is when they're never raising again, an exit. And they can raise that in 1 round or 3 rounds. The unfortunate reality that happens when people raise all 10 million at once in 1 round is they usually spend the capital really inefficiently. So they don't actually get as far as they needed to at the 10 million. So it's almost like if you get the 10 million up front, more likely than not, you're going to need 5 million more to get to the destination. Whereas if it was metered out to you, you have to make hard choices and be disciplined about how you test and allocate capital. And the net result usually is you're more capital efficient. So you might hit the end goal on the 10 million by itself. So that's the big issue. In theory, if you had the discipline to deploy each dollar as efficiently, regardless of when it was given to you, right? All 10 million across 3 rounds or all 10 million in 1 round, it didn't make a difference. You deployed the capital exactly the same way. You go slower, right? You don't spend what you can. In theory, founders do better, and from an ownership perspective, when they raise fewer rounds. The basic concept of how venture dilution works is that every time you raise a round, you're going to lose an average of 20% of the company. So if you own 50% going into it, 20% of that is 10%, you're going to be at 40 at the end. And every time you raise a round, you're going to lose another 20. Now, it could be 10, it could be 30, depending on how hot your deal is or how bad the market is or whatever. But if you just use that 20 as a rule of thumb, the calculus is pretty clear. You're better off raising more money in fewer rounds, but the catch is you have to be super disciplined. And the pattern is that everyone thinks they're going to be super disciplined, and 99 out of 100 times, people are not. They pave over cracks. They spend money on problems. They throw big parties. They scale too fast because they can grow the business faster, and that's exciting. It seems like a good idea. But in doing so, they might be spending more on acquiring customers than they would have if they had gone through a more disciplined development of their acquisition strategy. So short of it is, yes, raising fewer rounds is better. Usually the market doesn't, from a dilution standpoint for founders, the market on the VC side usually doesn't accommodate that. It's kind of structured so that founders are getting the appropriate range of capital for each stage. And so it's always about the same number of rounds. If you happen to have a super hot deal and can raise a $50 million Series A, which if you've never raised a Series A, that would be a quite high Series A, quite large. Great. But I'll be whispering in your ears, your friends saying, don't spend it. Tranche it out like it was 3 different rounds and see if you can be disciplined with it, because that will be financially far more valuable for the founder than even accelerating the business by a year in most cases.
Yeah, no, that's right. I think what I generally tell founders, just going to reiterate that, is that, raise what you need. Like, don't raise more than you can deploy effectively in that 18 to 24 month window that we were talking about. Because if you're doing that, then, you're unnecessarily diluting yourself. And then also, yeah, like, you don't have to be scrappy if you have way more money than you need. And then that leads to making the wrong choices.
It can also, last thing I'll add on it, because we're down a little bit of a rabbit hole here, is that can kill the company. So let's say the founder gets the $50 million huge check. And instead of making that last for 6 years or 5 years of development, which would have been like let's say it's 6 years, would have been 3 rounds worth, they deploy it all super fast and it doesn't go well. Raising more money when you can't show that $50 million generated more than $50 million in value, it's really hard. So it can actually close up the opportunity, access to future capital if you're not efficient with the money. So it's more than just a dilution risk. It can actually kill the business.
Yeah, no, that makes sense. Okay, so then now I wanted to move to the next part of the topic is really, how do you determine the number? What's the number? How do you figure that out of what you need? And the answer is, as we talked about before, is building an operating model. And so now when we're talking about an operating model, we're not talking about a full-blown financial model with accruals and tons of details. I think instead you're really building a monthly cash flow projection. So it's in between. It's an income statement with a cash balance. And it tells the financial story of your business, how you're going to run it. And I think most importantly, what your investors are going to be interested in is how you're going to drive results. Now, Mark, I know you have a very specific way that you think about it, and you're somewhat of a Google Sheet nerd.
No
Can
comment.
you can you walk us through like how you approach building this?
Yeah. So first thing I'd say is anyone who came from a consulting background or accounting or consulting, banking, or accounting background, it's too smart. The goal in this is actually to simplify it. For CFO types who know a sources and uses as a framework, this is kind of a variant of that. The gist of it is, I think this should be one sheet. Okay. So one tab. It should be one column equals 1 month, 60 columns, so 60 months, representing 5 years. Year 5 is going to be wrong. That's okay. But it gives you want to go 5 years out, because even if the math isn't right, it starts to give people a sense looking at, okay, if you adjust these toggles in year 1, what's the sensitivity down the road? You can start to show the growth potential. So I think you do 60 months, which is 60 columns. Each column essentially is a starting bank balance, revenue, expenses of all sorts. So you show COGS, you show gross margin, you take out OPEX, you show an EBITDA. And then you get an ending bank balance at the end of the month. And you carry that over to month 2. And so what you're doing now is you're basically integrating the P&L. You're looking at like, hey, we make this much money and we spend this much money, all on a cash basis. And here's how it affects our bank balance. And by putting those two together, what you can start to see is that based on the operating decisions you make, how fast you acquire customers, how much money you spend on hiring your team, all of those nuances can be illuminated within each column through numbers. You start to see the impact on how long the business will go before it needs to raise more money. And so you can say, okay, if I'm going to grow this business with salespeople, when I'm calculating my revenue, I'm not just going to say, hey, there's a big market, I'm going to have 1%. That's not a bottoms-up operational way of thinking. You're not just going to plug in a revenue number that sounds good. You're going to build up your revenue. You're going to say, all right, I'm going to hire a salesperson. Salesperson's going to do 3 sales calls per hour. They're going to functionally work 6 hours per day. And there's a conversion rate on those sales calls. There's an average value of a sale, and you're going to model in a delay for the cash flow to come in. And when you do all that math and crunch it, you'll know that every time you hire a salesperson, and you built in like a ramp up period for them to get trained up, how much money they make. And correspondingly down below in the model, you'll know, okay, we hired a salesperson. Well, we got to buy a computer. We got to pay for insurance and whatever else. And then you got your corresponding costs. Now you have to spend a little bit of time to get a hiring decision where the costs get mapped into month 1, but the revenue might not hit until month 3, 4, 5, or 6. But after you do all that little modeling and you get all these little numbers in there, you start to be able to create a real clear causality relationship between the business decisions you make about how to build the operation, the revenue, profit, and cash. And that's magical. Because then you can create a business scenario for like, okay, I'm going to hire someone at this time. At this point, I'll probably need this person. Kind of work off the lowest level intuition around like what you need to do to build the company. And it will translate into cash needs. And that can inform how much money you got to raise to go 18 to 24 months.
Yeah, and I think what's important that this demonstrates to your investor who's looking at this potential investor is how you think you're driving the business, right? What does your sales team look like? Is it mostly, is it all just sales driven? Are you attending trade shows? Are you doing what are the channels of marketing that you're using? The efficiency of those channels. And how you're thinking about driving each one that really impacts the top line. So I think it's all just how, all of these qualitative strategies in numbers.
Yeah, the operating model, I think back in the book I wrote a million years ago, I think the operating model is supposed to show how you build the company. And nothing communicates as clearly as math. And so what's great about that is when you sit down with an investor, and they're looking at this plan, they can say, hey, by the way, I failed at all the trade shows we've done and at all the other companies. We don't think this is a good idea. And you can actually talk about that and figure out if you should change the model and the strategy and the plan. They can look at it and say, okay, you're going to do search engine marketing. Great. We think your conversion rates and the assumptions in this are too high, too low, just right. And you can get aligned on that. And the beauty is once you get aligned on the inputs, then an investor could say, oh, holy crap, in year 5, this is a great business. Or not. Or it never scales to a level that justifies outside financing. But if you get you get aligned on the inputs, the rest is just formulas being accurate and then hard to argue about the output.
Yeah, and I think I think that's right. I think that's exactly how you should be doing it. I think a lot of founders, when they're doing this, a lot of times I see some of the same mistakes in their assumptions that they're making. There's some very common mistakes when you're doing that. It sounds easy enough when you're talking about it, right? But I think that there are a few watchouts when you're doing this. I think the first one is being overly optimistic about growth, especially earlier on. I think that when founders are making their assumptions, they assume that they'll hit product market fit faster than they actually do, or that their business will take off right after launch. But in reality, the growth usually takes longer, and it's rarely a straight line up and to the right. So that's just one thing to keep in mind while you're making your assumptions. I also think another kind of mistake that founders make is not leaving enough room for contingencies. Things are going to go wrong. Those marketing campaigns that we talked about before, maybe they're not effective as you originally thought, or product development will take longer. Your model needs to have a bit of cushion for that unexpected, those unexpected things to happen. And then lastly, don't underestimate your costs. There are a lot of hidden costs that need to be going into your model that you've forgotten about. Legal fees, software tools, hiring. Make sure you're accounting for all of that, because those hidden expenses really do add up.
I would even just add a 10% cost buffer, miscellaneous. My theory always has been overestimate the expenses, underestimate the revenue, and the math looks good. You're sitting pretty. Another common pitfall, Phuong, in this is people might go out and say, hey, we're going to do a sales-driven revenue growth strategy. And then they'll get one cell, one row in this model, and they'll create this big formula with a whole bunch of hard-coded inputs. I've got 2 salespeople in this month, and they're working X hours per day, and there's X days per month. And here's their conversion rate and the value and whatever else. It's really hard to communicate with nested formulas. I recommend people try to get to the point where every input is visible in a cell, hard-coded into a cell. So you might have one row, which is number of salespeople, another row, which is hours per salesperson per month. And then down below, 7, 8 blue text assumptions that people have typed into the model. There's a formula with no hard-coded inputs that just crunches that data. Everyone can glance at the formula once, like, okay, the formula is correct, but then they can have a really interesting conversation around the operating decisions. All right, should we delay hiring a person? Should we hire 2 instead of 1? And you can do that just by tweaking the blue cells. Very dynamic, easy way to kind of get aligned on the plan.
Yeah, great point. So yeah, I think just to wrap things up on this topic, I think, the key takeaway here is, figuring out how much money you want to raise is really comes down to balancing your capital needs with dilution, understanding how you're going to drive growth in your business, and building that really realistic operating model. I think my last piece of advice is that once you have this, know your numbers inside and out. When you're sitting across from an investor, they're going to drill you on your assumptions. And if it's going to be very obvious if you don't know them, and that's a sign of of a good founder and someone that's investable.
I'll add one more layer on it too. When you're getting into this model, there's usually kind of a first gear and a fifth gear growth strategy. All right, I hire 3 people versus 1 salesperson in the first year. And I think it's okay to go to market and fundraise with a funding range. We need $1 to $3 million. And it's a low and a high scenario, not randomly picked numbers, not numbers that are designed to fit within the expectations of VCs at this stage, numbers that are an output of your plan of what you want to build. And so if you have that low and high range, you can have a low and high version of the model. And it's so healthy as you're bringing on people on the team, everyone. This model can create tremendous alignment around what's happening and when. So very worth it. The range is a normal thing. So just don't panic if you're not sure. Just show the range.
I often, when I was a founder, even after we had raised the money, would go back to this model and stress test it and say like, okay, well, now I'm actually living this thing that I said I was going to do. And what's actualizing is this thing. And like, how does that, this is not as effective. This marketing is not as effective. How does this impact my runway? How do I adjust, other levers in the business to account for this? So it's actually, becomes kind of like a living tool.
Completely. I think that's a best practice. Updating it with actuals are the new reality. It's not really, they're usually not good. Once you create a model, they're usually not good accounting tools. Like everything historical, you just let the accountants actually do. But it's not crazy to sit back down in front of the model in month 13 and recalibrate it to figure out what you should be doing in month 14 and every month thereafter.
Yeah, that's right. Well, this was a great discussion. I think, just knowing the founders that I come in contact with all the time, I think this is going to be super helpful advice from especially you, Mark, being on the other side of the table.
Thank you for doing this, Phuong. Appreciate you.
All right. Thanks.
All right. This continues our series of trying to help educate the startup community. Hopefully it's helpful. If there's other topics you guys want us to cover, please shout at us. There's all the socials and ways to get at us. But otherwise, we'll catch you more next time.